Good morning and welcome to our session on issuer inspections, not to be confused with a broker-dealer session, which will be coming up later this afternoon. My name is Jack Griffith. I'm our Regional Associate Director. I lead up our Southern California Region office located in Irvine, and I'm joined today by Vic Rodriguez, an inspections leader in our non-affiliate firm program. Consistent with previous statements, before I begin, I would like to preface our discussion with the disclaimer that the views expressed here are in our official capacity as members of DRI, but are our own and do not necessarily reflect the views of the board members, or other members of the staff. Okay, here's another code for you all to enter, 858. Does everybody have access to the app, which allows you to enter the codes? Anybody having challenges with that? Straightforward? Okay. So we will focus our time in this session on three general areas. First, I'll provide a brief recap of 2023 inspection deficiencies. Second, I will provide an overview of our 2024 inspection program. Many inspections are currently underway, and I'll also provide some reminders regarding the remediation process. Third, Vic will take us through a deeper dive into certain areas of common deficiencies, as they are relevant to many inspections of smaller firms. Vic will share with you relevant audit requirements, and he will provide some examples of the audit deficiencies we have found. He will also describe some good practices for your consideration. Our relevant statistics regarding the 2023 inspections are included in the first bullet you see on the screen. Most of the public company audits we inspected in 2023 had year ends that ended in 2022. I think, unfortunately, 2023 was the third consecutive year where we experienced an increase in audit deficiencies that were inspected to be included in Part 1A of the inspection report. Additionally, as noted in the third bullet, findings included in Part 1B of the inspection reports, particularly related to audit committee communications and fraud considerations, increased over the prior year. Having talked about sort of the deterioration, I guess, or the continued deficiencies and the increase, we are cautiously optimistic about early 2024 inspection results, which indicate a modest improvement in the number of findings so far expected to be included in Part 1A of the inspection reports, as well as a decline in the number of quality control deficiencies included in Part 2 of the inspection reports. Firm remedial actions can take some time to implement, and there is often a lag between the implementation of those remedial actions and the resulting impact on the related audits. Next, we have a polling question. Which topic listed below was not included in the illustrative examples during this session at last year's forum? And I'll give everybody a few seconds to respond. I don't know if you can, oh, there we go. The correct answer is D. CAMS was not included in last year's forum, but was presented at the forum in 22. Vic will be discussing CAMS in a bit more detail in this year's presentation. So let's move on to 2023 areas of common deficiencies. Probably not a big surprise to most of you in the room, but deficiencies in control testing remain a common occurrence in both integrated audits and when controls are tested in a financial statement audit. Just to walk through a couple of examples. Relative to risk assessment, one common example we saw during 2023 inspections is that engagement teams did not reevaluate and revise its initial risk assessment after it obtained audit evidence that contradicted information which was based upon the initial risk assessment. So when in the field, the auditors became aware of information, they should have gone back and reconsidered their risk assessment based upon contradictory evidence that they had identified during the audit. Moving on to the next item, selecting controls to test. An example of a deficiency in this area was the engagement team did not identify and test controls that addressed the risk that the same individual could prepare and post journal ledger entries without approval. I think we're all familiar with this. This is the classic lack of segregation of duties, which can be quite common in a small company audit environment. To talk briefly about testing design effectiveness and an example deficiency we identified here, the engagement team did not evaluate the effect of incomplete information available to the control owner, and as such, the ability of the control as designed to effectively detect or prevent a material misstatement. Testing management review controls may also be somewhat familiar to you all. I think this is an area where we continue to see common deficiencies. We often see engagement teams noting sign-off by management as evidence that the management review was performed. Just as a reminder, a sign-off provides little or no evidence by itself about the control effectiveness. And I'll give you an example. MRCs are often prevalent in the area of asset impairment. Engagement teams need to understand the review procedures performed by the management around the reasonableness of projected revenue growth and other assumptions. Deficiencies remain high in this area, and auditors are encouraged to focus on auditor performance in these areas. Next, we'll get into some common deficiencies in the financial statement area. Revenue is another frequently selected focus area for us because of the complexities associated with revenue recognition policies and procedures. Vic will be discussing revenue in a lot more detail later on in our presentation. Inventory can also often present a significant risk of material misstatement due to the complexities in determining cost of the inventory and measuring inventory on hand at a point in time. Examples of deficiencies in this area include the engagement team not performing any procedures to test the accuracy and completeness of the period and inventory listing reports, or for that matter, inventory adjustments used in testing the existence of inventory. Additionally, we've found deficiencies associated with engagement teams not performing any procedures to test the movement of inventory between the interim and the final date when the physical inventory was not performed at the period end date. Let's chat about business combinations. I think business combinations, as we're all aware, can impact multiple accounts and involve challenging estimates, including fair value. Some common deficiencies in this area include engagement teams not sufficiently testing the valuation and allocation of purchase accounting, including forecast information used in valuations. Additionally, engagement teams are not sufficiently testing other significant aspects of the business combination, including contingent consideration. To briefly chat about investment securities, for those of you involved in the audit of banks, this is often the second largest asset class for banks. Engagement teams did not perform sufficient procedures to test the fair value hierarchy in the notes to the financial statements, so the leveling disclosures. Engagement teams also did not obtain an appropriate sample for testing the investments that could be expected to be representative of the population. Engagement teams also did not perform any substantive procedures to test assumptions used in the valuation of investments. Now let's move on to some additional categories of common deficiencies. First off is fraud. Material misstatements of financial statements due to fraud often involve the manipulation of the financial reporting process by recording inappropriate or unauthorized journal entries throughout the year or at period ends, or making adjustments to the amounts recorded in the financial statements that are not reflected in individual journal entries. As the staff have observed a number of deficiencies in this area, we will be doing a deeper dive into fraud and journal entry testing later, in addition to CAMS. Moving on to auditor tenure, we continue to identify deficiencies in auditor reporting of the year the firm began serving consecutively as the public company's auditor. A couple other probably familiar topics to most of you: audit committee communications. Deficiencies in this area range broadly across all firms. Deficiencies were noted where the auditor did not communicate to the audit committee an understanding of the terms of the engagement in an audit engagement letter and determined that the audit committee had acknowledged and agreed to the terms of the engagement. The firm did also not communicate to the audit committee the significant risks that were identified during its risk assessment procedures, and also critical accounting estimates and related significant assumptions with a high degree of subjectivity. To discuss Form AP briefly, 2023 was the 6th consecutive year of having to file Form AP, and we saw deficiencies decline in this area compared to 2022, but we still see an engagement deficiency rate of around 10%. Additionally, PCAOB teams conduct quality control reviews to assess a firm's system of quality control. This assessment includes evaluating whether identified deficiencies in individual audits indicate a defect or potential defect in a firm's system of quality control. In the area of independence, we continue to identify potential SEC violations of the financial relationship requirements. These potential violations include financial relationships, employment relationships, business relationships, non-audit services, contingent fees, and audit committee administration of the engagement, which typically includes not pre-approving all engagement services. In the area of engagement quality review, or EQR, the deficiencies are not limited to a single type or size of firm, nor are they limited to a specific type of engagement. Deficiencies range from the firm not obtaining the required EQR in an audit to the firm failing to perform its EQR review with due professional care. And lastly, monitoring. Firms, based primarily on size and structure, utilize a variety of methods to ensure that quality control policies and procedures established by the firm are suitably designed and being effectively applied. Monitoring involves ongoing consideration and evaluation and is often accomplished through an internal inspection program or similar monitoring program. A common inspection finding is that there has been no practice monitoring of public company engagements during the inspection period. Next CPE code for you all to enter is 210. Maybe I'll pause here and see if there are any questions based upon the material I've covered to this point. Okay. Having covered some of the 2023 inspection results, I want to cover the focus on our current inspections, which are underway. Many of our inspection plans for this year were presented in our spotlight released in December 2023, which is pictured on the screen here and publicly available on our website. I will focus on a few areas in my brief comments, but I encourage you to refer to the spotlight for more detailed information. And maybe this is kind of one area where I'll go a little bit off script here. I would think the spotlight that you see pictured on the screen here, as well as other spotlights that are available. I'll be talking about one associated with remediation later on. They're really great resources for firm practitioners to look at regarding information that the PCAOB has gathered and we deem to be very important in terms of getting into the hands of the practitioner. I am currently part of a centralized remediation team, and we often engage with firms during the remediation period. And it still is very surprising to me the number of firms that have not read or are even aware that these types of resources exist on our website. So would just encourage everybody in the audience today to, if you haven't recently, spend some time on our website. There's a ton of great information there that I think would provide some benefits. So our 2024 inspection program considers overall business risks present in the audits selected and inspected. A few of these business risks include persistent high interest rates, tightening of credit markets, and/or inflationary challenges, disruptions in the supply chain and rising costs, business models that are impacted by rapidly changing technology, the various geopolitical conflicts that exist around the world, and financial statements that include areas with a higher inherent risk of fraud, estimates involving complex models or processes, and/or presentation and disclosures that may be impacted by complexities in the public company's activities. We are also continually monitoring our inspection program using data and risk to focus on riskier engagements. Some of our enhancements to our inspection program this year include increasing the number of engagements reviewed. Specifically, during 2024, we plan to increase the number of engagements we select for review at certain annually inspected firms in response to heightened risk in certain industry sectors. We also continue to expand our inspection procedures. We will continue to perform inspection procedures on every engagement selected for inspection to assess compliance with certain aspects of the auditing standards related to independence, fraud, audit findings, audit committee communications, Form AP reports, the auditor's report, EQR, and audit documentation. We're also, as George, I think, alluded to in his comments, we're going to be increasing focus on a firm's culture of integrity and audit quality. Audit firms continue to face challenges in delivering quality audits, as evidenced by the increasing trend of audit deficiencies in recent years, and deficiencies identified that have occurred for numerous years. We often use the term repeat and persistent criticisms to identify these. We are interested in why these deficiency trends are not improving and whether a firm's culture is playing a role in the failure to improve. Improving the timeliness of inspection reports. This was a recommendation of the PCAOB's Investor Advisory Group. We continue to take additional steps to streamline our internal processes to enable more timely issuance of inspection reports. We will continue to place emphasis on selecting audits of public companies and industries and sectors with specialized accounting and/or that may be negatively impacted by uncertainties and volatility in the economic and geopolitical environment. Okay, I want to turn a little bit to the topic of remediation. As I mentioned earlier in my remarks, I am a member of our core remediation team. So I work with firms during the 12-month period after a report has been issued, where a firm can implement remedial actions to remediate the quality control criticisms included in the inspection report. The bullets on this slide are discussed in another spotlight that was issued by the PCAOB in February 2023, titled Additional Insights on the Remediation Process. I touched on this a few minutes ago, the concept of repeat and persistent criticism. So just to put a little bit more clarity around that, a repeat and persistent criticism is a quality control criticism that occurs in at least 2 consecutive inspection reports or occurs consistently, even if it skips 1 or 2 inspection reports. When dealing with a repeat and persistent criticism, we evaluate whether the firm's current remediation steps reflect change. In other words, do the current remediation efforts differ meaningfully from the types of effort the firm has described in previous remediation submissions, but do not appear to have sufficiently addressed the deficiency? So I'll give you one brief example here. If a response to an EQR, quality control criticism, and included in a previous inspection report was to modify the engagement quality review checklist that the firm uses. If that QCC recurs in a subsequent inspection report and the firm's response is again to just add the items from part 2 of the inspection report to the EQR checklist, there's a good chance that, that type of remedial action is not going to be viewed as a change. Subsequent inspection results. We consider subsequent inspection results as possible evidence of the effectiveness of a firm's remedial actions. As noted in the spotlight, strong remediation efforts, particularly when accompanied by effective firm monitoring procedures and timely adjustments, can weigh favorably in the inspection staff's remediation determined recommendation. So to the extent the firm has implemented remedial actions already during that 12-month remediation period, and let's say perhaps that they've been able to conduct an in-flight review or an internal inspection program, and they've seen how that remedial action that was implemented worked, they may identify some additional enhancements that are necessary based upon those inspection procedures. To the extent the firm can describe that and say how they are timely responding to those types of issues, that can be a very strong data point in a firm's remediation submission. Let's talk about design of newer revised guidance and tools. We consider the effective date of the guidance or policy, the method of communication and reinforcement to the practitioners, and whether a specific group or individual is responsible for execution and/or oversight of the new policy and guidance. For actions such as the introduction of a new tool, the staff considers whether use of the tool is mandatory and is reflected in the audit work papers. If a firm leaves to the discretion of its audit professionals whether to use the new guidance or tool, and it is not widely adopted, inspection staff may not consider the action appropriately designed. Let's move on to the design of training programs. We consider various items when evaluating the design of training programs, including whether the training is specifically tailored and provided to the appropriate levels of professionals within the firm. So, for example, if testing controls is a QCC and an inspection report, and a firm's remedial action is to provide training to partners and managers, but it's the seniors who are doing most of the test work in an area like that, that's something that we would want firms to think about relative to the appropriateness of the training population in that particular instance. The extent to which the training is mandatory for the target audience and the related participation, the quality of the content and the amount of time devoted to the specific quality control criticism, the content of the training, and by content we mean are there case studies and/or periodic testing during the training session, and how it changed from previously provided training, particularly in cases where the quality control criticism may be considered repeat and persistent. And also whether there is a post-course assessment and/or the training qualified for CPE credit. Lastly, we also consider the background and qualifications of the course instructors. Let's briefly talk about expectations regarding timing. The inspection staff considers whether a firm approaches its actions with diligence in the pursuit of progress within the 12-month statutory remediation period. The inspection staff expects a firm to design and implement appropriate remedial actions no later than the end of the 12-month deadline. Unless the firm can demonstrate progress against longer-term remedial actions, including the establishment of reasonable milestones, reflecting an appropriately aggressive approach to complete implementation. A good example where this might be appropriate would be to the extent the firm is undertaking a significant change in the firm's audit platform, which is being custom developed. That could be an example of a situation where it might be appropriate that you'd have a milestone type program given the effort undertaken to substantially sort of change the firm's audit methodology. To talk about the value of ongoing dialogue, and I think George also alluded to this in his comments, the importance of transparency. I think the remediation process is a great example where we have built in the opportunity for the firms to engage with us during the remediation period. So when the firm receives its inspection report, there's a cover letter. There are resources within the core remediation team that the firm has provided, and the firm is afforded an opportunity to engage with us and dialogue with us during that 12-month period. You would think substantially all firms would take advantage of that process, including engaging with us early during the remediation period, but unfortunately, this is not always the case. So take advantage of the opportunity to engage with us early and often during the remediation cycle. We do provide feedback on draft remediation submissions, and we found that the earlier and more often that firms engage with us, the higher likelihood that a remediation submission is going to lead to a potentially satisfactory recommendation. And then lastly, just want to touch on root cause analysis and the importance of it. The inspection staff believes that a firm's analysis of the root causes of a quality control criticism may be helpful in determining whether an action is relevant and appropriately designed to remediate the quality control criticism. The more thoughtful the firm's root cause analysis process, the more likely the firm will identify the causal factors, which will then in turn enhance the likelihood that its remedial actions will be effective in preventing similar deficiencies. We issued a recent spotlight in April 2024 on root cause analysis, and I encourage you to refer to that document for additional information. So before I turn it over to Vic, I'll pause again and ask if there are any questions, and I think we might have some time at the end of the session as well to respond to any. Okay, Vic?
Yeah, I can do it.
Okay.
Yep, thank you. Good morning. My name is Vic Rodriguez. I am an inspections leader in our non-affiliate firm, or NAF Inspections Program. As Jack mentioned, we'll go through some illustrated examples for 3 areas in which we observed deficiencies during the 2023 NAF inspections. And those 3 areas include revenue and related accounts, fraud, including journal entries, journal entry testing, and critical audit matters, also referred to as CAMs. For each area, we will discuss what the standards require, common deficiencies from our 2023 inspections, and good practices that our inspection teams have observed. The first area that we'll cover is revenue, and with that, we have a polling question. So, which PCAOB standard is applicable to the audit of revenue and related accounts? A, AS 1105, audit evidence. B, AS 2201, an audit of internal control over financial reporting that is integrated with an audit of financial statements. C, AS 2301, the auditor's response to the risk and material misstatement. D, AS 2501, audit and accounting estimates, including fair value measurements. Or E, all of the above. Okay, I'm going to give you seconds here to answer. Do we know when the poll closes? Okay, so whenever I close it. Okay, so the answer here is E, all of the above. What we'll do now is go over the applicable PCAOB standards on the next few slides. While there's no specific PCAOB auditing standard for revenue, AS 2301, the auditor's response to the risk and material misstatement, is applicable as the auditor should design and perform audit procedures in a manner that addresses the assessed risk of material misstatements for each relevant assertion of each significant account and disclosure. In designing audit procedures, to be performed, the auditor should obtain more persuasive audit evidence the higher the auditor's assessment of risk. And also take into account the types of potential misstatements that could result from the identified risk and the likelihood and magnitude of potential misstatements. With regards to an integrated audit, the auditor should design the testing of controls to accomplish the objectives of both audits simultaneously to obtain sufficient evidence to support the auditor's control risk assessments for purposes of the audit of financial statements, and also to obtain sufficient evidence to support the auditor's opinion on internal controls over financial reporting as of year end. The standard outlines that the audit procedures for an account, such as revenue, should be commensurate with the risk assessment and the likelihood and magnitude of potential misstatements. The higher the risk, the more audit evidence the auditor should obtain. Okay, we have another CPE code, it's 298. Can you jot that down or enter it? 298. Continuing on, AS 2401, consideration of fraud in a financial statement audit, is applicable when improper revenue recognition has been identified as a fraud risk. And as a reminder, improper revenue recognition is a presumed fraud risk. If there is an identified fraud risk that involves improper revenue recognition, the auditor may also want to consider certain procedures within AS 2401, paragraph 54, which are summarized on the screen, such as disaggregated substantive analytical procedures and observation of period-end shipments. The procedures performed to respond to the fraud risk should be tailored to the specific fraud risk identified for the public company. Okay. There are also other PCAOB standards to consider when auditing revenue. This graph shows the auditing standards most frequently referenced in Part 1A of our PCAOB inspection reports. As you can see, the most frequent cited standard is AS 2201, an audit of internal control over financial reporting that is integrated with an audit of financial statements, followed by a tie between AS 1105, audit evidence, and AS 2301. The 2022 findings are consistent with 2021, with deficiencies in testing controls being the most often cited standard. This graph of common financial statement deficiency areas, which can be found in the staff update and preview of 2023 inspections observations on the PCAOB website, shows that revenue continues to be the most common financial statement area with deficiencies identified. As illustrated in the graph, the number of revenue-related deficiencies is consistently much higher than that in other audit areas. Additionally, the graph indicates that the number of deficiencies in revenue is trending up year over year. So before I move the slide, we're going to go over some examples of revenue deficiencies we've seen through our inspections. And for each example, I'll provide you a brief summary of the facts and then show the deficiency identified. So for this first example, the facts include that the issuer is a provider of consulting services and business applications. The issuer has multiple revenue streams, including consulting revenue, software revenue, subscription revenue, and maintenance revenue. The engagement team tested selected revenue streams as follows. For commission revenue, the engagement team selected a sample of revenue transactions and performed the following procedures. 1, vouched the selected transactions to internally generated invoices and customer payment support. 2, it recalculated the invoice amount based on the billable hours and billable rate and compared it to the invoiced amounts. And 3, compared the billable hours per the internally generated invoices to the approved time cards. With regards to subscription revenue, the engagement team selected a sample of revenue transactions and vouched the selected transactions to 1, internally generated invoices and 2, customer payment support. With regards to disclosures, the engagement team completed a gap disclosure checklist and recalculated the issuer's disaggregation of revenue and deferred revenue balances as disclosed in the footnote. So, what were the deficiencies identified? With regard to commission revenue, the engagement team did not perform any procedures to test the contractual arrangements to determine if the revenue was recorded appropriately in accordance with ASB ASC topic 606. With regards to subscription revenue, the engagement team did not perform any procedures to test whether the issuer's performance obligation had been satisfied before revenue was recognized beyond obtaining contracts or purchase orders for certain transactions, internally generated invoices, and customer payment support. And lastly, with regards to the disclosures, the engagement team did not identify and evaluate the issuer's omission of a required disclosure related to, 1, the methods used to recognize revenue, and an explanation of why the methods used provide a faithful depiction of the transfer of goods or services, and 2, the allocation of the transaction price for contractual arrangements with multiple performance obligations. Okay. This second example relates to the use of certain reports used by the engagement team during its audit of revenue. The facts for this are as follows. The issuer is a manufacturer who sells products directly to customers at retail locations, as well as through e-commerce platforms. The engagement team obtained certain revenue reports as part of their audit procedures, which included an issuer-prepared monthly sales report and a monthly report from PayPal showing payments received, payments sent, withdrawals and debits, credits, and fees and transfers. The engagement team used these reports when performing audit procedures related to revenue. The deficiency noted by the inspection team was that the engagement team did not perform procedures to evaluate the relevance and reliability of the reports from external sources and test the accuracy and completeness of the issuer-produced reports used in the testing of revenue. Okay. For our third example, the issuer has fixed fee revenue arrangements and measures its progression to completion using an input measure of total cost incurred divided by estimated total project cost expected to be incurred. The engagement team identified a fraud risk related to improper revenue recognition and identified estimated project costs expected to be incurred as a significant assumption. To test revenue, the engagement team selected a sample of revenue transactions and performed the following procedures. 1, it reviewed the underlying contracts. 2, it tested the actual cost incurred. 3, it recalculated the percentage of completion. 4, it also recalculated revenue recognized and agreed it to the general ledger. And finally, 5, it examined cash receipts. The deficiency noted here was that the engagement team did not perform any substantive procedures to evaluate the reasonableness of the significant assumption related to the estimated total project cost to be incurred that the issuer used to determine the amounts recognized as revenue. Okay. So that concludes the revenue examples that we have, and at this point we have another CPE code, which is 731. So in addition to deficiencies identified, inspection teams take note of good practices. A good practice could be a procedure, technique, or methodology that is appropriately comprehensive and suitably designed in relation to an audit firm's size and the nature and complexity of the audit firm's practice that may contribute to the quality of the audit services. Some of which you can find and are discussed in the spotlight titled staff update and preview of 2022 inspection observations. The good practices on this particular slide relate to obtaining an understanding of the issuer's revenue processes and performing a robust risk assessment. To perform a robust risk assessment, the risk assessment can be done at a disaggregated level, such as revenue stream level, assertion level, or account level. For example, assignment of likely sources of potential misstatements to elements of an estimate or calculation. Risk should be tailored appropriately by considering varying risk for different components, portfolios, locations, and revenue streams. The risk assessment process is supported by a robust walkthrough in which an auditor can obtain a detailed understanding of the issuer's revenue to better identify the risk and plan audit procedures to respond to the risk associated with the issuer's revenue. Included on this slide are a few more good practices which focus on the firm's developed templates to assist engagement teams, and these can also be found in the spotlight that I just mentioned. So these examples include firm risk assessment templates that help engagement teams better capture and clearly document linkage between likely sources of potential misstatements and the controls to be tested, including data and data reports used as evidence, sometimes referred to as information provided by the company or IPC. Firm templates for testing estimates, such as a template that maps individual assumptions and inputs and related risk to controls and substantive testing approach. And also firm templates for testing controls with a review element. Okay. So let's wrap up the revenue section with a polling question. In your opinion, which element of auditing revenue is the most challenging? A, management's estimates. B, satisfaction of performance obligations. C, required disclosures. Or D, completeness and accuracy of reports. Okay, and just give everyone a little time to respond to that. Okay, looks like most people responded with management's estimates. And for this particular question, there is no one right answer. As we saw with the example deficiencies, all these areas can be challenging depending upon the issuer. Okay. Now we'll move on to our next topic, fraud, including journal entry testing. As stated in AS 2401, consideration of fraud in financial statement audit, the auditor is responsible to plan and perform the audit to obtain reasonable assurance that the financial statements are free of material misstatement, whether caused by error or fraud. And as you can see on the slide here, there are various relevant standards that relate to fraud, which include paragraphs 14 and 15 of AS 2201, as well as paragraphs 52 through 85 of AS 2110. One of the first steps that should be taken by the auditor is to identify fraud risk factors. Fraud risk factors are events or conditions indicating incentive or pressure to perpetrate fraud, opportunity to carry out the fraud, and or an attitude or rationalization that justifies fraudulent action. These are the elements of the fraud triangle. The auditor should identify relevant fraud risk factors at the issue. Subsequent to identifying these fraud risk factors, the auditor should assess the fraud risk factors and develop a response to them. AS 2401, paragraph 13, stresses the importance of exercising professional skepticism. AS 2110, paragraphs 56 and 57, notes specific inquiries that the auditor is required to make regarding fraud risk, including inquiries of management, inquiries of the audit committee or equivalent, or its chair. If the company has an internal audit function, inquiries of appropriate internal audit personnel, and inquiries of others within the company about their views regarding fraud risk. When performing analytical procedures, the auditor should look to see if there is a contradictory evidence and continue to exercise professional skepticism. AS 2401, paragraphs 79 through 82, discuss requirements around communicating about possible fraud to senior management, the audit committee, the Securities and Exchange Commission, as well as others. AS 2401, paragraph 83, discusses requirements around documenting the auditor's consideration of fraud. And just to recap, audit procedures performed in relation to fraud were identify and assess fraud risk factors, make required inquiries, perform analytical procedures, respond to the assessed fraud risk factors, communicate where applicable, and document your assessment and audit response. Okay, and speaking of documenting, we have another polling question. Which of the following are required to be documented as part of the engagement team's consideration of fraud? A, a discussion among engagement personnel regarding the susceptibility of the entity's financial statements to material misstatements due to fraud. B, when improper revenue recognition is not determined to be a fraud risk, the reasons supporting the auditor's conclusion. C, the results of procedures performed to address the assessed fraud risk. D, A and C only, or E, all of the above. Taking a look at responses, most of the audience selected A. And actually, the answer to this polling question is E, all of the above. And all of these requirements are outlined in AS 2401, paragraph 83. Continuing on with fraud procedures, AS 2401, paragraphs 57 through 67A outlines audit procedures to address the risk of management override of controls, which includes examining journal entries and other adjustments for evidence of possible material misstatement due to fraud, reviewing accounting estimates for biases, and evaluating the business purpose for significant unusual transactions. Drilling down into the audit procedures to address the risk of management override of control, AS 2401, paragraph 58, specifically addresses procedures the auditor should perform when testing journal entries. Obtain an understanding of the entity's financial reporting processes and the controls over journal entries and other adjustments. Identify and select journal entries and other adjustments for testing. Determine the timing of testing and inquire of individuals involved in the financial reporting process about inappropriate or unusual activity relating to the processing of journal entries and other adjustments. Okay, at this point, we have another CPE code, which is 233. 233. Okay, what we're going to do now is go through some examples of deficiencies related to journal entry testing. And as with revenue, I'll provide a brief summary of facts and then show the deficiency identified. So for this first example, the engagement team documented the following risk criteria for selecting journal entry testing. Journal entries posted by the CEO, CFO, or similar person. Journal entries with keyword descriptions. Out of balance journal entries ending in 999, and journal entries identified through Benford's law analysis. Okay, let's take a look at the deficiency that was identified. The engagement team did not sufficiently support its fraud risk criteria used for identification and selection of journal entries for testing because the engagement team did not evidence an appropriate rationale for how certain factors in AS 2401 resulted in the identification of its fraud risk criteria. What we should note here is that AS 2401, paragraph 61, has a listing of criteria to consider. For our second example, the engagement team identified fraud risk criteria 1 through 5 that we just mentioned in the first example and supported its fraud criteria, determined which journal entries met the fraud criteria, and tested a sample of those journal entries that met the criteria. The deficiency here was that the engagement team inappropriately excluded the journal entries from testing that met its identified fraud risk criteria without having an appropriate rationale for limiting its testing to the sample of journal entries that it selected. For our third example, the engagement team identified journal entries for testing. However, there was no evidence in the audit file that the engagement team agreed the journal entries to underlying supporting documents. The deficiency identified by the inspection team was that the engagement team did not obtain and review the supporting documentation and approvals for journal entries identified by its fraud risk criteria. Okay, so that concludes the fraud examples related to journal entry testing that we want to go over. And we have another polling question. So true or false? Fraud risk must be communicated to the audit committee. Okay, it looks like got our responses here. The majority of the people said true, and the answer for this one is true. Per AS 1301, Communications with the Audit Committee, paragraph 9, the auditor should communicate to the audit committee an overview of the overall audit strategy, including the timing of the audit, and discuss with the audit committee the significant risk identified during the auditor's risk assessment procedures. And another item to note is that fraud risks are a category of significant risk. Okay, what we have on the slide are a few good practices for journal entry testing that we've observed through our inspections that could help prevent some of the deficiencies that we just went through. 1, training for all partners and professional staff on AS 2401, including journal entry testing. 2, the use of templates that includes specific procedures to test the journal entry population. And 3, pre-issuance review programs focused on the journal entry testing. Okay, so what we have now is a short case study on communications with the audit committee related to fraud risk. And in the interest of time, I'll go through the scenario, the question, and then the answer for this. The scenario is as follows. The firm assessed some significant risk, including fraud risk. 1, management override of controls. 2, improper revenue recognition due to fraud. And 3, lack of proper segregation of duties for payroll. They had a meeting with the audit committee on November 19, 2022, which included discussion of the significant risk, an overview of the audit strategy and the timing of the audit, and findings and recommendations from the prior year audit. The firm's engagement team interviewed management as well as non-management employees about the fraud risk. And we fast forward to February, when the firm issued its audit report on February 26, 2023, and then communicated the results of the audit to the audit committee and management shortly thereafter on March 12, 2023. So, has the firm satisfied its obligation with respect to communications with the audit committee related to fraud risk? And the answer here is no. There's no indication that the firm made inquiries of the audit committee about whether the audit committee is aware of matters relevant to the audit, including fraud risk. We know the firm made inquiries of management and non-management, but not necessarily the audit committee as well as, not necessarily the audit committee as well. This is a requirement under the auditing standard AS 1301. Additionally, though not specifically related to fraud risk, the timing of this communication is problematic. The firm waited until after it issues its audit report on February 26th to make the communications with the audit committee on March 12th. AS 1301 requires all required audit committee communications need to be made before issuance of the audit report. Okay, now we're going to move on to our third topic, critical audit matters. AS 3101 defines a CAM as a matter arising from the audit of the financial statements that was communicated or required to be communicated to the audit committee, relates to accounts or disclosures that are material to the financial statements, and involved especially challenging, subjective, or complex auditor judgment. It is a requirement of AS 3101, paragraph 17, to evaluate and document the evaluation of whether or not a matter that was communicated or required to be communicated to the audit committee and relates to accounts or disclosures that are material to the financial statements is a CAM. The auditor must evaluate whether or not the matter was determined to be a CAM. For example, involve especially challenging, subjective, or complex auditor judgment, and document the basis for such determination. This graphic shows a high-level summary of the steps an engagement team should perform to complete the CAM evaluation. And I know it's a little small here, but you can find this in one of our spotlights, staff priorities for 2024 inspections and interactions with audit committees. It starts with evaluating whether the matter was communicated or required to be communicated to the audit committee, then whether it relates to a material account or disclosure. Next is the evaluation of whether the matter involves especially challenging, subjective, or complex auditor judgment, using the criteria outlined in AS 3101, paragraph 12. Then, if the matter is a CAM, it needs to be communicated to the auditor's report, in the auditor's report, as outlined in AS 3101, paragraph 14. Before we continue with CAMs, we have another CPE code, which is 546. Common CAM deficiencies relate to determining what matters are CAMs, as well as how the CAMs are communicated in the audit report. Next, we have some fact patterns and some examples of common deficiencies from the 2023 inspections. For our first example, the engagement team made communications to the audit committee related to the following matters: impairment of long-lived assets, related party transactions, going concern, uncorrected misstatements, revenues, income taxes, and stock-based compensation. However, the engagement team did not evaluate these matters as potential CAMs. The deficiency noted here was that the engagement team did not perform any procedures to determine whether matters which were communicated to the audit committee and which related to accounts or disclosures that were material to the financial statements were critical audit matters. For our second example, in the auditor's report, the engagement team described that one of the procedures to address the CAM was to evaluate management's ability to accurately forecast the revenue growth rates by comparing forecasts used to historical growth rates, which in fact those procedures were not performed. The deficiency for this example was the engagement team did not accurately describe how the CAM was addressed in its audit report, because the description in the audit report described audit procedures that were not in fact performed in the audit. For our last example, in the auditor's report, the firm did not include a description of the principal considerations in its auditor's report that led the auditor to determine that the matter was a CAM. The deficiency for this example was the engagement team did not describe in its auditor's report the principal consideration that led the auditor to determine that the matter was a CAM. In this next slide, we have some good practices that the firms have, that we've observed and the firms have implemented in the area of CAMs. One is the use of templates to assist with the evaluation of all matters communicated to the audit committee and consideration of factors outlined in AS 3101, paragraph 12, as well as the involvement of others outside the engagement team for review of CAMs in the auditor's report. These good practices focus on supporting engagement teams as they assess the CAMs. Okay, and with that, we have our final polling question related to CAMs. Which of these audit committee communications is not required to be evaluated as a potential CAM? A, going concern, B, significant risk, C, timing of the audit, or D, illegal act? And just, taking a look at the answers here, I'm not sure if the question is read correctly, or maybe you just didn't read it correctly, but it just say, which of these audit committee communications is not required to be evaluated as a potential CAM? So this relates to CAMs. The majority of the audience selected A, going concern. The answer actually is...
I think it's C, actually. Yeah.
Right.
It might be
well, that's what they selected, but the answer is C.
93% selected C. I think you're just looking at the top.
Oh, I see what you're saying.
Yeah.
Okay. All right. So you guys are right. Timing of the audit. So what we'll do here is we wanted to provide some additional commentary about the answers, A, B, and D. So with regards to going concern, a CAM may also relate to many accounts or disclosures and have a pervasive effect on financial statements. For example, the auditor's evaluation of a company's ability to continue as a going concern could represent a CAM, depending on the circumstances of the individual audit. For significant risk, it is not expected that all significant risk will give rise to CAMs, or that all CAMs will necessarily be related to an identified significant risk. The factors relevant to identifying significant risk overlap with but are not identical to the criteria that apply in determining CAMs. In determining whether a matter involved especially challenging, subjective, or complex auditor judgment, the auditor is required to take into account the factors set forth in AS 3101, paragraph 12, including the auditor's assessment of the risk of material misstatement. So, for example, if responding to a significant risk did not involve especially challenging, subjective, or complex auditor judgment, the auditor will not determine that a related CAM exists. And conversely, responding to risk of material misstatement that do not rise to the level of a significant risk may involve especially challenging, subjective, or complex auditor judgment, particularly when the risk relates to areas in the financial statements. And Finally, for legal acts, a potentially illegal act about which management provided disclosures could be determined to be a CAM, even if the amounts involved were not quantitatively material, such as a disclosure on its own may be qualitatively material. On the other hand, if management appropriately determined that no disclosure or accrual was required in financial statements, the matter will not be a CAM. Okay, so that covers the topics that we want to discuss, and with that, I will turn this back to Jack. And it looks like we're kind of just about out of time.
Yeah, so appreciate your perseverance, right? That was a ton of material to cover, incredibly detailed. I think to summarize, a ton of what we covered is available in detail via the spotlights on our website, and I would strongly encourage all of you to take a look at those materials, because as I mentioned in the remediation process, it continues to be an area where we find that practitioners are often not looking at that documentation that's available to them, and I think it would just enhance your understanding of kind of what we are currently focused on, not only from a remediation process, but just the inspection process more broadly. So with that, we're happy to respond to any questions, or you can feel free to catch Vic or myself at one of the breaks, maybe before lunch, and we'd be happy to answer any questions you have at that time as well.